Hey folks, happy Monday, happy Memorial Day. Being Monday, it is time for the next episode of the Quintuple M, the Monday Mr. Money Mustache Motivation. Today's episode is coming from his blog post posted on June 9th, 2011, How to Tell When the Stock Market is on Sale. We'll get right into it. In a recent article in this investing series, I mentioned that the S&P 500 index has delivered an annualized return rate of a little over 11%, 7% after inflation, for the past 60 years. But what caused that generous rate of return? And is there any way to know if the market is likely to return to a similar or drastically higher or lower rate during our own investing lifetimes? To make a surprisingly educated guess, you just need to understand the formula that determines each individual company's share price. Share price equals the company earnings per share times the price to earnings ratio. The price to earnings ratio, PE for short, is further determined by these factors: earnings growth in recent history times bullshit random estimates for further growth. Thus, companies that have recently been enjoying growing profits and are flashy and exciting and thus expected to see continued profit growth are rewarded with higher PE ratios and thus higher stock prices. A good example of a currently stylish company is Google, which trades at a PE of 20. Google shares are worth $500 each because their earnings per share are $25 multiplied by the PE of 20. A less flashy but still very profitable counterexample would be the oil company Chevron. Its share price is only about $100. Earnings per share are $10.30 and the PE ratio is a nice conservative 9.71. If the PE ratio were the same as Google, Chevron stock would be worth over $200. This is because investors expect Google to grow much faster than Chevron over the coming years. But since nobody can really predict the future earnings of a company more than a few months in advance, the bullshit random estimates factor is subject to revision each and every day, which is why the stock market fluctuates so wildly. Luckily, when you're looking at the whole collection of 500 large companies over a period of many decades, you can see a much more sensible pattern. An average PE ratio makes itself visible, which turns out to be the number 16.4. They get this number by calculating a weighted average of the PE ratios of all the 500 companies in the S&P 500 index. So you could say that when the stock market PE ratio is above 16.4, it's unusually expensive. When it's below this number, it is on sale. You can, of course, dig deeper into the details and find exceptions to this rule, but a detailed statistical analysis of the market history shows that if you can buy the stocks when they are on sale way below 16.4, your next 10 to 20 years of investment returns are unusually good. If you buy when it is way higher than 16.4, you are likely to get lower than average returns. This is because in the long run, company earnings and dividends tend to grow at a fixed rate, the same rate as the entire U.S. economy, which has been about 3.3% after inflation for most of modern history. If you buy a stock which pays a 2% dividend and its earnings grow at 3.5% per year and the PE ratio stays the same over time, it turns out you'll get a 5.5% return after inflation or 8.5% or so before inflation on that stock. But if the stock market temporarily goes in or out of fashion and the PE ratio rises or falls, your return could be much higher or lower. From the 1950s to the year 2000, the PE ratio went up quite a bit, which provided great returns for investors over that period. In the dot-com peak of March 2000, the S&P index was teetering at a dramatically high PE ratio of over 30. In March 2010, 10 years later, the companies were actually earning more money, but the stock index was worth about 30% less. That is because people were less euphoric over stocks at the time, so the PE ratio was much more realistic in 2010. In March 2009, there was a massive stock market crash, and the stock prices fell so low that the PE ratio was only in the 13 range, a level of bargainville that hadn't been seen since about 1986. If you bought stocks back then, you are already up about 100% in 2 years because both earnings and the ratio investor enthusiasm have grown. So what is the current PE ratio of the index? It is the current price, $1,280 divided by last year's total earnings per share for the companies, $78.86, giving a ratio of 16.23, right around the average. So the stock market is right where it should be historically speaking, and if this ratio persists, you will get a return equal to the U.S. GDP growth plus the current dividend yield that the stocks are paying right now, 1.83%. That adds to 6.83% before inflation. If, on the other hand, PE ratios go higher due to enthusiastic investors pouring back in as they did in the 1980s and 90s, you may get lucky. If you are doubly lucky enough to know when to cash out some of your gains into more stable investments before everything reverts back to the mean. My last paragraph of this blog post is my favorite one. I still don't recommend trying to outsmart the stock market by timing a repeated series of buys and sells, but I still like following this evaluation method to determine if I'm crazy to add more to the stock portfolio at any given point in time. When the market strays quite far from the mean PE ratio, that's something to get excited about. So yeah, this blog post, honestly for me, it's highly informative, but this is a lot more complex and deep into investing than what I would like to get. Things like this, it's why dividend investing sort of intimidates me a lot. I still feel like at its most base level, dividend investing is stock picking, and I just don't know that I'm confident enough to choose the right stocks, so to speak. So for me, the thing that appeals to me as far as investing goes is just index investing. I like the simplicity of it. As J.L. Collins says in his book, The Simple Path to Wealth, which I actually have yet to read, but I'm going to. I know that he mentions several times that time in the market is better than trying to time the market. So basically just invest in the regular and take the highs with the lows and know that over time your investment will grow if you're just investing in a basic index fund, which is what I plan to do when I start investing. The thing that I struggle with a little bit right now is paying off debt versus investing. You know, you hear out there in the investing world, if you're as nerdy about it as I am, that everyone is expecting the market to correct anytime. Now, obviously, nobody knows when that's going to happen, but I know that there are people out there who kind of are hanging on to money that they could be investing otherwise because they're, you know, concerned that the market is too high right now. They don't want to get their money in the market right now and then have a correction next month or the month after. They'll feel like that, you know, they didn't get the best deal. But J.L. Collins' argument to that is you never really know which way the stock market is going to go, and it's better to just put your money in if you have it and let it grow over time. I tend to be of that mind myself because I don't really know enough about investing to feel confident trying to time the market. And also, I know that I should be investing, and it really does tear me up that I can't invest as much as I want to right now because I have this debt. But I have recently come across something that is making me wonder whether I shouldn't start investing right now versus waiting. And I think that I may do a whole video about it here soon separately, but it's a very loose rule called the 5% rule, which basically is saying that if you have debt that is higher than 5%, higher than 5% interest that you're paying, you should focus all your efforts on trying to get that debt gone before you invest. And if it's less than 5%, then theoretically you would be better off investing your extra money into the market because you would earn more in the market than paying off the debt quickly. But the argument against that thought is, if you pay off your debt, that is a guaranteed return on your money. You're getting rid of that debt. You're not having to pay that interest in the future, even if it is a small amount. So with my student loans now being at an interest rate of 4-point-something%, and my car loan is a little over 5%, I do want to focus on paying off my car. However, I know that paying off both my student loans and my car is going to take probably another 2 years. So I'm torn. I feel like I ought to do something to invest. I'm really drawn towards a Roth IRA. You know, the thing about Roth IRAs is there's a limit to the amount that you can contribute every year, and once the year is gone, I mean, you don't get that time back. So I'm sort of thinking that I may open up a Roth IRA and begin investing in there, even with some debt that I currently have. If I choose to do that, it will probably affect my goal that I had of paying $30,000 towards debt in 2019. You know, if I start investing regularly into a Roth, then yeah, that's going to take away some money that I could put towards debt. So really, I'm torn about it, and I think that I may do a whole video about it later on, and we'll discuss it, and maybe I can get some feedback from y'all too about what you would do in my situation. So yeah, as always, I will link the link to this blog post in the description box below and down in the comment section too, if y'all want to go check it out and see what other people had to say about this article. Again, I think this is a pretty deep one. It goes into more detail than what I would normally look at when deciding to invest. So yeah, I will link that down below, and let me know what you think of this article. Again, happy Memorial Day, and I'll see you in the next one. Bye. What?